What the proposition says: in a world with no taxes, no transaction costs, and perfectly symmetric information, the way a firm splits its financing between debt and equity does not affect its total market value. Think of a pizza. The total size of the pizza firm value stays the same whether you cut it into many small slices, lots of equity, or a few big slices, lots of debt. Formal proof outlines. Assume two firms, A and B, are identical in operating assets, risk, and cash flow generation. Firm A is all equity financed, Firm B is partially debt financed. Investors can create homemade leverage. A shareholder of Firm A can borrow at the risk-free rate and buy extra shares, mimicking Firm B's cash flow pattern. Because investors can replicate any capital structure on their own, arbitrage would force the market to price both firms the same. V sub A equals V sub B. Mathematically, V equals V sub U, where V is the market value of any leveraged firm and V sub U is the value of the unlevered firm. The proof hinges on the law of one price. Identical cash flows must have identical prices when markets are frictionless. Key idea: adding debt changes the risk of equity, so equity holders demand a higher expected return. The overall cost of capital, however, stays constant. Derivation. Let E be the market value of equity, D the market value of debt, and V equals E plus D the total firm value. The required return on equity R sub E must compensate equity holders for the extra risk they bear due to leverage. The required return on debt R sub D is usually close to the risk-free rate because debt is senior and less risky. The weighted average cost of capital, WACC, for the leveraged firm is WACC equals E over V times R sub E plus D over V times R sub D. Proposition 1, no tax, tells us that WACC equals R sub U, the cost of capital for the unlevered firm. R sub E equals R sub U plus open parenthesis, R sub U minus R sub D close parenthesis times D over E. This is the famous Proposition 2 formula. It shows that equity's required return rises linearly with the debt-to-equity ratio. Analogy: imagine a seesaw. The board firm stays level overall cost if the children debt and equity sit at appropriate distances. When the debt child moves closer to the pivot more debt, the equity child must move farther out higher return to keep the board balanced. What changes when corporate taxes exist? Debt interest is tax deductible, creating a tax shield that adds value to the firm. Think of a discount coupon. Each dollar of interest reduces the taxable income, saving the firm tax dollars. Firm value equations. Let V sub U be the value of the firm if it were all equity, unlevered. Let T sub C be the corporate tax rate, D the amount of debt, and R sub D the cost of debt. The present value of the perpetual tax shield is T sub C times D. If we assume the shield is discounted at the cost of debt, which equals R sub D in the original proof. Therefore, the value of a leveraged firm is V sub L equals V sub U plus T sub C times D. This formula shows a linear increase in firm value with each extra dollar of debt. The firm becomes more valuable because it saves taxes. Real-world illustration. A company earning $100 million before interest, with a 30% tax rate, would pay $30 million in taxes if it had no debt. If it issues $200 million of debt at 5% interest expense is $10 million, reducing taxable income to $90 million. Taxes drop to $27 million, saving $3 million. Exactly the tax shield T sub C times D equals 0.3 times 200 equals 60 in present value terms, adjusted for the discount rate. Explanation: when debt is tax-advantaged, equity holders still require a higher return, but the relationship is altered because part of the firm's cash flow is now protected by the tax shield. Adjusted MM2 with corporate tax. Start from the no tax MM2 RE equals RU plus RU minus RD times D over. Incorporate the tax shield by recognizing that the effective cost of capital for the firm is now RU times 1 minus TCD over V. The weighted average cost of capital falls as debt grows. Solving for RE yields RE equals RU plus RU minus RD times D over E times 1 minus TC. The term 1 minus TC reduces the slope of the line: each additional dollar of debt raises equity's required return, but not as steeply as without taxes, because the tax shield cushions shareholders. Analogy: imagine a car with a fuel efficiency bonus tax shield. Adding a heavy trailer debt normally makes the car work harder, higher equity return. But if the bonus reduces fuel consumption, the extra effort needed is smaller, the slope flattens. Key takeaway: tax-deductible interest lowers the cost of debt, which in turn reduces the extra risk premium equity must demand. Mathematical note: the derivation assumes the tax shield is perpetually valued at TCD if the shield is discounted at the weighted average cost of capital. Instead of RD, the formula slightly changes, but the intuition stays the same. Explanation: in reality, investors face personal taxes on dividends, interest, and capital gains. These taxes can differ across debt and equity holders, altering the conclusions. 2. Tax rate framework. T sub C, corporate tax rate as before. T sub E, personal tax rate on equity, income, dividends plus capital gains. T sub D, personal tax rate on interest income. Effect on firm value. The after-tax benefit of debt becomes T sub C times D for the firm, but investors receiving interest pay T sub D on that interest, reducing the net benefit to the holder. Net advantage to the firm is now T sub C times D minus T sub D times D equals T sub C minus T sub D times D. If T sub D greater than T sub C, the tax shield can actually hurt the firm's value, because investors are taxed more heavily on interest than the firm saves. Adjusted MMI with personal taxes. V sub L equals V sub U plus T sub C minus T sub D times D. Adjusted MMII with personal taxes equity cost. R sub E equals R sub U plus R sub U minus R sub D times D over E times 1 minus T sub C, divided by 1 minus T sub E. The fraction 1 minus T sub C divided by 1 minus T sub E captures how much of the tax shield actually benefits shareholders after they pay personal tax on equity returns. Real-world analogies. Think of a discount coupon that you can use at the store: corporate tax shield, but you have to pay a processing fee, personal tax, each time you redeem it. If the fee is larger than the discount, you're worse off. Implication for capital structure decisions. Companies must consider the tax regimes of their shareholders. In countries where interest is heavily taxed at the personal level, the incentive to use debt diminishes. Practical observation. This explains why some high-tax jurisdictions, for example United States, still see firms relying heavily on debt. Personal tax rates on interest are often lower than corporate tax rates, preserving a net shield. The pure world ignores the real cost of financial distress, bankruptcy, renegotiation, lost customers, etc. Adding these costs creates a trade-off between the tax shield benefit and the expected distress cost. Modified firm value formula. VL equals VU plus TCD minus present value of expected distress costs. The distress cost is usually modeled as a function of the debt level, often increasing convexly, for example alpha D squared, or a probability-weighted loss. Simple numeric illustration. Assume VU equals 500, TC equals 0.30, D equals 200. Tax shield equals 0.30 times 200, which is 60. Expected distress cost equals 0.1 times D, which is 20, representing 10% of debt as expected loss. Therefore, VL equals 500 plus 60 minus 20, which is 540. If the firm adds another $100 of debt, new tax shield equals 0.30 times 300, which is 90. New distress cost equals 0.1 times 300, which is 30. VL equals 500 plus 90 minus 30, which is 560. The incremental value from the extra $100 of debt is $20, smaller than the $30 tax shield because distress cost ate part of it. Eventually, adding more debt will make present value of expected distress exceed the tax shield, reducing firm value. Graphical intuition. Plot firm value versus debt. The line starts at VU, rises with slope TC, representing the tax shield, then bends down as distress cost curvature dominates. Implications for managers. Seek the optimal debt level where the derivative of VL with respect to D equals 0, that is, marginal tax shield equals marginal distress cost. In practice, estimate distress probability using credit ratings, cash flow volatility, or market-based spreads. Analogy: imagine a farmer planting crops representing debt. Each extra acre yields a subsidy, the tax shield, but also raises the chance of a pest outbreak, the distress. The farmer must stop planting once the expected loss from pests outweighs the subsidy. Mathematical form common in textbooks. VL equals VU plus TCD minus gamma D squared divided by 2, where gamma captures how fast distress costs grow with debt. The optimal debt, D star, equals TC divided by gamma. Assumptions dash unlevered firm value operations V sub U equals $1,000. Cost of equity for the unlevered firm R sub U equals 10%. Cost of debt R sub D equals 5%, risk-free for simplicity. Corporate tax rate T sub C equals 30%. No personal taxes, no distress costs. First illustration, then we add distress. Firm A, low leverage dash debt D sub A equals $100. Equity E sub A equals V sub A minus D sub A to be solved. Firm B, high leverage dash debt D sub B equals $400. Equity E sub B equals V sub B minus D sub B. Step 1: compute firm value with tax shield, MMI with taxes. V equals V sub U plus T sub C times D firm A: V sub A equals 1000 plus 0.3 times 100 equals 1030. Firm B: V sub B equals 1000 plus 0.3 times 400 equals 1120. Step 2: derive equity values. E sub A equals 1030 minus 100 equals 930. E sub B equals 1120 minus 400 equals 720. Step 3: compute cost of equity using M2 with taxes. R sub E equals R sub U plus open parenthesis, R sub U minus R sub D close parenthesis times D divided by E times open parenthesis 1 minus T sub C close parenthesis. Firm A: R sub E sub A equals 0.1 plus open parenthesis 0.1 minus 0.0. 5 close parenthesis times 100 divided by 930 times 0.7, approximately 10.04%. Firm B: R sub E sub B equals 0.1 plus open parenthesis 0.1 minus 0.05, close parenthesis times 400 divided by 720 times 0.7, approximately 10.19%. Interpretation: the heavily leveraged firm enjoys a larger tax shield, higher total value, but its equity becomes riskier, so shareholders require a slightly higher return. Adding distress costs, use the quadratic form present value of distress equals gamma times D squared divided by 2, with gamma equals 0.0002. Distress cost A equals 0.5 times 0.0002 times 100 squared equals 1. Distress cost B equals 0.5 times 0.0002 times 400 squared equals 16. Adjusted firm values: V sub A star equals 1030 minus 1 equals 1029. V sub B star equals 1120 minus 16 equals 1104. Equity values become E sub A star equals 929 and E sub B star equals 704. Required equity returns rise a bit because E is lower, but the main story is that the extra debt no longer adds as much value due to distress costs. Takeaway for MBA students: use the simple formulas first, then adjust for realistic frictions, taxes, distress, to see how optimal leverage is a balance, not an infinite push toward debt. Table summary: firm, debt dollars, tax shield dollars, distress cost dollars, value dollars, equity dollars, R sub E%, and so on. The table makes the trade-off crystal clear. Below are 3 typical MBA-style exam questions on the Modigliani-Miller theorem, each followed by a concise outline of the solution steps. Question 1: Pure MM1, no tax proof. A firm has an unlevered value of $500 million. It decides to issue $200 million of debt at the risk-free rate of 4% and use the proceeds to repurchase equity. Assuming no taxes, transaction costs, or bankruptcy risk, what is the new market value of the firm? Show the arbitrage argument that leads to your answer. Solution outline. 1. State MM1 no tax. V sub L equals V sub U. 2. Because investors can create homemade leverage, any difference in price would create an arbitrage opportunity. 3. Therefore, V new equals $500 million, unchanged by the capital structure shift. 4. Briefly illustrate the arbitrage. A shareholder of the unlevered firm can borrow $200 million at 4% and buy extra shares, replicating the leveraged firm's cash flows. Question 2, MM2 with corporate taxes. A company has an unlevered cost of capital R sub U equals 12% and can borrow at R sub D equals 6%. The corporate tax rate is 35%. If the firm issues $300 million of debt, compute A, the firm's value, B, the required return on equity, and C, the weighted average cost of capital. A. Use M1 with taxes. V sub L equals V sub U plus T sub C times D, assuming V sub U equals $1,000. Compute V sub L equals 1,000 plus 0.35 times 300 equals 1,105. B. Apply MM2 with taxes. R sub E equals R sub U plus open parenthesis R sub U minus R sub D close parenthesis times D over E times open parenthesis 1 minus T sub C close parenthesis. First find E equals V sub L minus D equals 1,105 minus 300 equals 805. Plug numbers. R sub E equals 0.12 plus open parenthesis 0.12 minus 0.06 close parenthesis times 300 divided by 805 times 0.65. Approximately equals 0.12 plus 0.06 times 0.373 times 0.65. Approximately equals 12% plus 1.45% equals 13.45%. C. Weighted average cost of capital equals E over V sub L times R sub E plus D over V sub L times R sub D times open parenthesis 1 minus T sub C close parenthesis. Compute weights. E over V equals 805 divided by 1,105 approximately 0.73. D over V approximately 0.27. WSCC equals 0.73 times 13.45% plus 0.27 times 6% times 0.65. Approximately equals 9.82% plus 1.06%, approximately equals 10.88%. Note that WSCC is less than R sub U because of the tax shield. Question 3, trade-off theory, tax shield versus bankruptcy. Consider a firm with unlevered value V sub U equals $800, corporate tax rate T sub C equals 25%, cost of debt R sub D equals 5%, and a linear expected bankruptcy cost of 0.02 D, that is 2% of debt. Determine the optimal debt level that maximizes firm value using the modified MM formula V of D equals V sub U plus T sub C times D minus 0.02 D. Solution outline. 1. Write V of D equals 800 plus open parenthesis 0.25 minus 0.02 close parenthesis times D equals 800 plus 0.23 D. 2. Since the coefficient on D is positive and constant, the model as specified suggests the higher the debt, the higher the value, implying an infinite optimal D, which is unrealistic. 3. Discuss that a realistic model would have distress costs increasing faster than linearly, for example gamma D squared over 2. Show the corrected formulation. V of D equals 800 plus 0.25 D minus gamma D squared divided by 2. 4. Choose a plausible gamma equals 0.001. Take derivative. dV over dd equals 0.25 minus gamma d equals 0. So d star equals 0.25 divided by 0.001 equals 250. 5. Compute optimal value. V star equals 800 plus 0.25 times 250 minus 0.5 times 0.00. 1 times 250 squared equals 800 plus 62.5 minus 31.25 equals 831.25. 6. Conclude that the optimum balances the marginal tax shield, 25% of each extra dollar, with the marginal increase in bankruptcy cost, gamma d.